Hi, Michelle. The Fed has made its first rate cut in nearly a year. How do you see this shift in policy impacting confidence in credit markets? Do you expect a change in deal flow or changes in pricing?
The U.S. lower middle market has emerged as one of the few reliable sources of deal activity, as overall M&A has slumped over the past 2 years. With the Fed beginning to cut rates for the first time in a year, we believe the conditions are aligning for renewed market momentum, especially for the lower middle market. Private equity's increased interest in the lower middle market has reshaped the market. Entrepreneurs and family business owners are increasingly turning to private equity for an exit from businesses, particularly in industries traditionally seen to be rooted in local economy, such as HVAC, plumbing, fire and life protection, elevator servicing, and landscaping. These businesses offer private equity the opportunity to professionalize, scale, and consolidate sectors that have long remained outside of the mainstream U.S. M&A. We expect this deal flow to continue to remain strong and even accelerate as rates come down. The broader market backdrop, driven by sponsor-to-sponsor M&A transactions, is one of more muted deal activity. The rising or elevated interest rate environment over the past 24 months plus pushed up financing cost, limited valuation growth, and left sponsors reluctant to transact unless absolutely necessary. With the Fed's first rate cut signaling a potential change in sentiment, we believe the lower middle market is poised to experience an acceleration ahead of the broader market. Smaller businesses typically have simple capital structures and use less leverage. Given these factors, along with the size of the businesses, they are more sensitive or easily impacted by cost of capital. As a result, we expect that even modest reductions similar to the recent Fed rate cut can encourage deal-making activity. While we believe deal activity will increase in Q4 25 and the first half of 26, pricing or spread over the near term will likely remain unchanged. There remains in the market a supply-demand imbalance, too much demand, after 2 years of elevated rates. Spreads will begin to come up only after M&A volumes return to more normalized levels for a period of time, so it's hard to predict how long this will take. Despite this, the first Fed rate cut in a year continues to be a positive indicator of expected near-term lower market deal activity.
Thanks, Michelle. That all makes perfect sense. We look forward to talking to you soon.